From WBRN Radio and on the Bostonred Network. This is the This Week in Economics on the 10th of November 2018. This is the numbers man section of our information portfolio, I guess we'll call it. Nonetheless, we have the producer price index, and we have other information from a variety of sources. We're adding the Investors Daily. Their polling, we use it on the political side. This is their economic optimism index. Something new we're adding. And we probably used it before, but we'll use it this time around. And, of course, we have our regular roundup from the Bloomberg people and from Reuters. And we'll end up with the BBC, but we'll be looking at a number of different kinds of indicators here as we move merrily along with this week's information period. So we'll just start off with the Investors Daily's poll. This is Economic Optimism Index. This is a monthly poll from the business the Investors Business Daily. Is a collaboration with them and Technometrics organization here, and it's how competent consumers, workers, and investors are in the pace and direction of the U.S. economy, as well as all other IBD proprietary monthly indexes. A reading above 50 is optimism, and below it is pessimism. It's made up of three. This is the Index Optimism Index is made up of three sub-indexes, including one for respondents' outlook for 6 months into the future, the respondents' personal financial outlook, and how respondents view current federal policies. The goal of each month is to give an accurate reading of the current state of the economy as possible. The average of the index over the past 17 years has been around 49.6, slightly pessimistic. The index high of 62.9 was reached in March of 2006, 6 months after the 9/11 attack. Americans, of course, rallied behind the response. That would have been an outliner, we'd call it. The index's bottom was in August of 2017 at a 35.8 as the economy struggled to emerge from the Depression. Nonetheless, the index in November is at 54.4%. The optimism index fell 2.4% in November to 56.4% after rising 3.8% in October. 57.8. The index in current months have backed off of August. The high in August was 58. It was at that level. Was the second highest reading since 2004. November marks the 26th straight month that the economic optimism index has been over 50, which signals overall optimism about the economy, a record for this index. It is also well above its long-term average of 49.6. The index stood at 44.4 in December of 2007, the beginning of the Depression. Now, the 6 months outlook is forward-looking gauge that looks at the consumer feeling about the economy's prospects over the first half of the year. The index edged down in November 0.2% to 53.2 from 53.3 in October. The volatility gauge surged about 11.4 in January, then bounced up and down for several months. The reading for the index remains optimistic territory and well above its average of 46.6. The index stood at 32 in December of 2007, the beginning of the Depression. The Personal Financial Outlook Index, it's high here, gauge of how Americans feel about their own finances. The next 6 months fell 6.6 to 62.3 from 66.7 in October. November's drop erased the October gain. The index all-time average was 65.3. That was in January of 2004. That was when the Bush-era tax cuts began to kick in. A stimulus program from G.W. Bush. It jumped in January's tax cuts went into effect. The Personal Financial Outlook, most consistent optimistic index in the IBD data set. It remains above the long-term average of 57.3. The Federal Policy Index is a measure of confidence in the government. The Federal Policy Index component rose 0.6% in November to 53.7 from 53.4 in October. The gauge, which in October stood at its highest level since January of 2007, remains above its 17-year average of 45. The index briefly moved into optimistic territory in February of 2017 for the first time in 10 years. March of this year, it returned to the feel-good zone, intended to gauge how Americans view government policy, put in place by the President, Congress, the courts, the Federal Reserve. The Federal Policy Index has consistently been the least optimistic of the three indexes that make up the Economic Optimism Index. So this is where it is. A very interesting point there on government policy. Our take on that is that there's a sense of false consciousness here in that government policy, if you take the totality of the policy, it is not going to be as productive in outer months. What I mean by that is we're in Q4 now. As we go into Q1, Q2, Q3 of 2019, the many things will start to happen, and we'll get to some of those. One, we're seeing inflation return with the Producer Price Index. We'll get to that, one of our topics here. We'll leave that particular situation, and we will move to Bloomberg. And these are mortgage applications. Just a little bit of the gauge of U.S. mortgage application fell last week to its lowest level in almost 4 years as borrowing costs hit the highest since 2010. Adding challenges to the housing market, the Mortgage Bankers Association market composite index fell 4% in the week ending the 2nd of November to 316.2, the lowest reading since December of 2014. That's according to a report. The survey contract rate of 30-year fix rose to 5.15% from 5.11%, which while the gauge of applications to purchase homes dropped 5%. the lowest in 2 years. The data signal higher mortgage costs are even growing headwinds for the U.S. Homebuyers, who have already faced a drift of affordable listings, affordable listings. Residential investment has been a drag on the economy growth for 5 of the past 6 quarters. Recent data shows cooling in sales in construction. Higher borrowing costs have come to the Fed raising its interest rates 8 times since December of 2015, part of the strategy to keep the strengthening labor market from overheating. The central bank's open market committee started a 2-day meeting on Wednesday in Washington, and they did not raise the rates. We hadn't announced that yet, but we are now. And we move on here. We'll get back to that. GE, we started doing a little information thing. This is from Reuters. Their shares have plummeted below $9. This is General Electric. On Friday, after J.P. Morgan analysts slashed its target price of stock to below only $6. Who would believe this? Shares shrunk, GE, that is, at 7.3% to $8.44 after afternoon trading, dropping as low as $8.15. The price fell to $9 for the first time since 2009. Friday's research note from J.P. Morgan's analyst Stephen Tusser follows GM's third quarter results late last month, in which the company posted a staggering loss of $22.8 billion. Tusser has been bullish on the stock. It said, we lost our thing here. I'm not sure. We have something with Reuters here while we are going around. What Tusser said had been bearish on the stock out of GE's 8 reporting segments, all of which were profitable. Even 2 years ago, 6 are now likely there. So GE has its problems. While its liquidation is certainly debatable, we believe that it is not really about liquidity. It is about the erosion in run rate fundamentals, noting that the deep drop for GM shares from $30 that was in 2017. This move still does not sufficiently reflect the fundamental facts in our review. Tusser kept his underweighted rating. That's for GE. So GE definitely has its problems and will continue to have some problems. On the energy level, we're talking petroleum here. This is also from Reuters. It fell 1%. U.S. crude on the longest losing streak since 1984. 1984 was a different type of economy. Benchmark crude has slid about 20% or more since peaking in early October. What a difference a month makes. That is from Larry Trim, a commodity strategist at RBC Capital Markets. Market sentiment has shifted from the most bullish tone in years, with many calling for $100 only week ahead, to the weakest investor sentiment since the 2016. The benchmark fell 46 cents, or 17%. This is benchmark Brent crude at $70.18. Fell below $70 for the first time since April, and as much as 20% off for the 4-year high in October. The slump, about 3.6% for the week and 15% for the quarter, fell from for the 10th straight day, the longest streak since July of 84. The Texas component, that is, declined to 48 cents to $60.19 a barrel. Hedge funds are cut bullish wedges on the crude oil in last week to its lowest level in more than a year. Demand worries follow a forecast for slower economic growth in 2019. This is what we were talking about on the optimistic gauge there from the Business Investors Daily, largely due to the trade war with China. China's data shows producer inflation fell in October for the fourth straight month. It needed to do that, and on a cooling domestic demand and manufacturing activity, the report sent global stock in a tailspin, or peaked in October over the view that the U.S. sanctions on Iran would come into force. This week would drain global crude reserves and bring shortages in some regions. But big producers, this we're talking here about the U.S., Russia, and Saudi Arabia, are pumping more petroleum product than what they've normally been. Inventories in Cushing, Oklahoma, the delivery point for U.S. crude futures, have risen for the seventh straight week. That is in the Keystone XL pipeline, running from Nebraska down to Cushing and on to the port in Galveston, Texas. The problem is some of the Keystone has been blocked by a federal judge in Montana. Doesn't really matter because it's just the liquidity is just not there. And let's see, what else do we have here? Slump in oil prices, China data. That was the same one, I believe, we just read from Reuters. Chinese data snapped demand for equities while oil prices weakened again on Friday. A little different report here, but it's basically the same situation. European stocks dropped as mining and oil stocks sold off. They managed to end the week with a small gain. Oil is spooking the market. If oil prices are going to go lower, that's another sign that the global economy is going to slow its growth. That is from Chris Zaccaretti, Chief Investment Officer at the Independent Advisors Alliance in Charlotte, North Carolina. It looks like a slow stock sell-off. All the long days have been drifting lower. And the average won't get there because the Federal Reserve, of course, had hoped that sharp share prices fall during what has been called Red October might have encouraged the U.S. Central Bank to take a more dovish approach to monetary policy. Pan-European index lost 0.37 there, and just some things coming in from around the nation, around the world. I'm sorry about that. Energy firms added oil rigs, and we didn't get to this. Added rigs for the fourth week in the last 5, bringing the total to 886, the highest since March of 2015. And also, U.S. sanctions on Iran are unlikely to cut supplies as expected. Washington has granted, exemptions to some people. In South Korea, the Chinese National Petroleum Corporation said it's taking oil from Iranian fields, which it has stakes. So, we already talked about Cushing still returning to oil production cuts by OPEC. It allows its alliance next year cannot be ruled out. 2 OPEC sources said this week a ministerial committee of some OPEC members met in Abu Dhabi. So they could cut it back. They're trying to raise prices that they've been having some problems with here. So energy service fuel jumped in producer price index. We'll get to that in a minute. The prices paid by producers rose 0.6 in October. We'll get to that. U.S. stocks opened lower as a batch of weekly China data raised concerns. Here, slump in oil prices, we looked at that. We'll try to get the China data into the report here. And from Bloomberg, basically the same thing. Producer price index here. And we'll see if we can just get this. I don't know if we can get this little report from Bloomberg in here. The 10-year yield. And see exactly where it is. We put this puzzle into the right, correct perspective. And we may or may not be able to get that article in here, but again, it's not going to work for us. That's okay. Back to Reuters here. Just a growth wobbly, or is it the beginning of the end? This is two of the world's largest economies probably shrunk last quarter from a proof of the global past its peak. This is Germany and Japan are both expected to report negative growth figures in the coming days. For now, few economists predict a global downturn as the U.S. economy is motoring ahead. Yes, it is, but it's beginning, as they say, to sputter. U.S. growth is well. We won't even get into that one there. Germany, the Eurozone's biggest economy, is expected to report on Wednesday a 1/10% drop in its GDP. And Japan is not doing much better in Japan. So let me just... we'll report this while we're here. American Express won approval to clear card payments in China, making it the first U.S. card network to gain direct access to what is set to be the biggest bank card market by 2020. So one of the Visas, rival Visa and MasterCard, have sent applications there. One of the big problems here, if you're going to have those people in entities, I should say, into China, foreign card companies have had to partner with China Union Pay. That's a state-controlled consortium. Foreign payment cards, especially behemoths like Visa and MasterCard, have been lobbying for more than a decade for direct access to China, where a number of cards in circulation expected to rise to 9 billion. That's by 2020 from 6 billion now. Boy. It's quite a market, and this is all what it's all about. Markets, and more markets here. Let me go to the BBC while we're here, and let's do the producer price index. We'll try to figure this one out. And here we go. This was released on Friday, the 9th of November. And the producer price index for final demand rose at 0.6% in October, seasonally adjusted from the U.S. Bureau of Statistics reported today. Final demand price advanced 0.2% in September and declined 0.1% in August. On an unadjusted basis, the final demand index increased 2.9 for 12 months ending in October. In October, over 60% of its rise in final demand price can be traced to 0.7% advance in the index for final demand services. Prices for final demand services, moved up for final demand goods, moved up 0.6%. Index for final demand, less food, energy, and trade services rose 0.2 in October after climbing 0.4 in September. For 12 months ending in October, prices for final demand, less food, energy, and trade services advanced to 2.8%. And we will append this to our report. Final demand services, the index for final demand services increased 0.7 in October, the largest advance since climbing 0.8 in January of 2016. Nearly 3/4 of the broad-based October rise can be traced to margins from final demand trade services, which moved up 1.6%. Trade services measure changes in margins received by wholesalers and retailers. Prices for final demand services less trade, transportation, warehousing, and final demand transportation and warehousing services increased 0.2. Produce details. 1/5 of the October advance in prices for final demand services attributed to 1.2% in the margin for machinery, equipment, parts, supply, wholesaling, the index for food and alcohol retailing, health, beauty, optic goods retailing, inpatient care, apparel, jewelry, footwear, and accessories, and travel accommodation services also moved higher. In contrast, the price for loan services fell 0.5. The index for hospital outpatient care and furniture retailing also declined. Final demand goods, the index for final demand goods climbed 0.6 in October, the largest rise since advancing 0.9 in May. Nearly 3/4 of the October increase can be traced to prices for final demand energy, which moved up 2.7%. The index for final demand food rose 1%. Prices for final demand goods, less food and energy, were unchanged. Index for final demand goods climbed 0.6%. Oh, sorry about that. Index product and detail. Over 60% of October's increase in prices for final demand goods is attributed to the gasoline index, which jumped 7.6%. Prices for diesel fuel, fresh and dried vegetables, beef, veal, cigarettes, jet fuel also moved higher. Conversely, motor vehicle index fell 0.7% in accordance with the usual practice. The most newer model passenger cars and light motor trucks were introduced into the index in October. Their quarterly change for 2019 motor vehicles at prices for liquefied petroleum gas and fresh fruits and melons also decreased. Very interesting. Processed goods are for intermediate demand. The index for processed goods for intermediate demand increased 0.8% in October after no change in each of the previous months. In October, the broad-based rise was led by prices for processed energy goods, which advanced 2.6%. The index processed materials, less energy, and processed foods and feed both moved up 0.4% from the 12 months ending in October. The index for processed goods for intermediate demand climbed 5.9%. Unprocessed goods for intermediate demand moved up 3.6% in October, the largest increase since the 3.6% rise that was in January of 2017. Prices for unprocessed energy materials climbed 3.6%, while the index for unprocessed non-food materials, less energy, was unchanged. Prices for unprocessed goods for intermediate demand rose 7.8%. Services for intermediate demand in October, 60% of the broad-based advance that can be traced to margins for the trade services for intermediate demand, which climbed 1.5%. The index for services less trade, transportation, warehousing for intermediate demand moved up 0.2%. And prices for transportation, warehousing services for intermediate demand moved up 0.3% for 12 months ending in October. The index for service rose. Intermediate demand rose 3.2. Margins for metals and materials and ore wholesaling, which jumped 7.8%. This is a sign that basic types of metals, minerals, etc. all rose. The index for broadcast and network TV advertising sales, paper and plastic products, wholesaling services related to security broking and brokerage and dealing, partial portfolio management, scientific and technical consulting services also moved higher in contrast to gross rents for retail properties that fell 4.1%. Prices for cable advertising, times and sales and car rentals also declined. Immediate demand price drops. Prices for intermediate demand advanced, 0.5% in October, the largest rise since moving up 0.5% in May and October. The index for total goods input to stage 4 increased by 0.5%. Prices for total service input climbed 0.4%. Advances the index for diesel fuel, metals, minerals or wholesaling, paper and plastic, gasoline, portfolio management, basic organic chemicals outweighed decreases in prices for gross rents for retail properties. Soft lumber and citrus fruits for the 12 months ending in October. The index for the stage 4 intermediate demand moved up 3.6. I won't go over all of these because we're going to append these, but again, in October, prices for goods input to stage 1 intermediate demand at 1.5%. Index for total services climbed 0.5%. Increase in index for basic organic chemicals, diesel, metals, minerals, and ores. Wholesaling gas, crude oil production, paper, plastic. Wholesaling outweighed declines in prices for aluminum-based scrap, or aluminium, how you want to pronounce it. Gross rents for retail properties, passenger car rentals for 12 months. The index for stage 1 intermediate demand advanced 6%. That is, kind of get the picture of what is going on here. Effective with the release of October, the producer price index includes data for the 21 resample industries classified in 2017's North American Industry Classification System. The Bureau of Labor Statistics periodically updates these, and some of them they're adding on here. See current issues: dog and cat food manufacturing, beet sugar manufacturing, bottled water. Won't go into all these, but there's some that have come in here: plastics, metals, and motor vehicles, home centers, paints and wallpaper stores, office and retail appraisers, blood and organ banks. I guess this is something totally new here. These are just some announcements of some of the things that they are adding on. Each year, the release producer price index data for January, seasonally adjusted, negative importance. They will be released on February the 12th. Direct seasonal factors, the producer price commodities index for the year 2019, and several other things here. You'll get this you can read it. The producer price index, Bureau of Labor Statistics, is a family of indexes that measure the average change over time in prices received, prices changed by producers for domestic products, goods, services, and construction. The price changes from a perspective of the seller, the contrast with other measures such as the consumer price index, etc. More than 10,000 for individual producers, groups of producers are part of this index, and we zip right by it. But you can read the technical note here about what they're attempting to do: final demand, intermediate demand, etc. These are sub-indexes here. The final demand portion measures price change for commodities sold or for personal consumption, capital investment, government, and export. The system is comprised of 6 main price indexes: final demands for goods, final demand for trade, final demand for transportation, warehousing services, etc. So this tops it all. We'll go to the BBC now as we wrap up things here. People are stockpiling food in the BBC in Britain, the UK. That is how bad it gets here. And anything else fresh there? No, that seems like it. Other than bomb brother is cutting 5,000 jobs nationwide. That's an aviation company that's struggling plane and train manufacturer. Canadian aerospace giant announced 6,000 job cuts around the world. So, in other words, here we go again. Now let's get the stockpiling of food here, and we'll do the numbers. It might be a bit crazy, it admits Jocelyn Kamawaski, I think. Anyway, this is some of the stuff she's evidently stockpiling here over basic fears. Spokesman for the department for exiting the EU is unequivocal. People should not be concerned, but they are stockpiling food in case things go the other way. A face group called said the 48 preparers, and named after the proposition, a proportion of people who voted to remain in the EU, suggest stockpiling more than everyday items in the group of around just 1,600 members. So it's sort of like the Y2 2000 scare we had here. I suppose they'll have plenty, but you literally never know. And let's get to the Bloomberg Commodities Index here. That index was down 0.77. The UBS was off also, a negative 8.97. The Reuters was off negative 1.29. The Reuters Intermediate was off negative 12.54. And energy, we already got the Brent crude is at $60 and this is the Texas Intermediate, they call it a little bit different anyway, is at $60.19. T-Boone Pickett still jumping for joy. It's off 48 cents. Brent crude at $70.18. It will go down off 47 cents. The gasoline index down $2.29. Natural gas up 18 cents. Home heating oil, winter's here, 49 cents there. Gold on the COMEX down $16 at $1,208.60. Gold on the spot was down $14.35 at $1,209.65. Silver was down 28 cents at $14.14. Copper was down. Copper was down at what? $5.15. Platinum on that spot was down $11.06. Corn was down $3.75. Wheat was down $5.75. Cocoa was down $5. I know about cotton. It was down 68 cents. And live cattle. We don't have pork bellies. We got to go find pork bellies. $2.08 there. And stocks, let's see. We did some of the Dow. Let's skip a little bit here, and we'll start in Asia. The Nikkei was off 236.67 in the Tropics was down also 8.27 in Hong Kong. The Hang Seng was down 625.80. In the CSI index was down 45.33. And a number of other indexes here. Well, we'll have to go to the BBC to get some others. We have to get around here. In Europe, the Eurostas was down 8.11. The FTSE was down 35.34. The DAC was was up 1.84. In France, they were down 24.70. In Spain, they were also down 42.20. And that leaves only the U.S. here. The Dow was down 201.92. The Nasdaq was down 123.98. The NYSE Composite Index was down 84.51. So that is some of what is going on here. We can go find the BBC once again, as we won't go through here. Anyway, let's get to BBC so make sure we didn't miss anything here. We have to use a two market data here from the old BBC. I think we got the FTSE. The FTSE was off. The FTSE 100, that is, was down 0.49% here. The FTSE. Well, we always use the FTSE 100. And in Amsterdam, they were actually in the positive at 0.20. In France, we already gave that one. They were down 0.48%, 48%. The Eurostas was down 0.25% there. And in Spain, in Madrid, they were down 0.46%. We've already given the Dow. In Chicago, they were down, S&P 500. Anyway, they were down 0.92%. In Bombay, they were down a negative 0.22% there. The Hang Seng was, I think we already gave that. The Nikkei was also down a negative 1.05% there. And the euro was actually gained 1 penny, I suppose. Oh, well, anyway. I think we already gave the Forex and natural gas index. We got everybody. Wait a minute here. Yeah, we got the Hang Seng. You got Bombay. We got Tokyo. They do it slightly different here, anyway, between the BBC and the other one, where they are. We're looking at the Investor Daily here. We were going to find, maybe the Russell 2000, but I'm not sure we are able to find the Russell 2000. I'm not sure why. Not what we were looking for here, but again, we occasionally look at the Russell 2000. This is one of the things we're going to straighten up. We'll get this straight here. and we're not getting it where we want it at all. This is, all of a sudden I'm getting the 1st of November. Well, these are small caps. Usually we don't have as much in terms of problems here finding it. Oh, we just go to Market Watch when in doubt. The Russell 2000, it's down 1.82%. This is the Russell 2000 here. From the Market Watch people. And this gives all the nice situations here. And what, 1,549.9. Anyway, that is what we have for the Russell 2000, and we'll just actually wait a minute, just a minute here. Yeah, it's down. What did I say? 28.72. This is from CNN Business with the Russell 2000. The change was 1.82. And quickly here we'll go. Yeah. Anyway, so much for the Russell 2000, the small caps here. And we'll fly over to Bloomberg on the Russell 2000. Yeah, same thing. It's down 28.72. This is from Bloomberg. And their index is here. The Russell 2000 is comprised of small 2,000 companies like the Russell 3000. We don't do the Russell 3000, but sort of shows one where the small caps are. This will do it for us. For those in business, make next week a productive one. We don't have any statistics on the holiday season as to how the retailers are doing, but we're at the 10th of November now. We move very, very quickly. There is some pre-Friday, what they call Black Friday sales going on at Walmart and some of the others. They're offering free shipping. That's all we know. But a consumer, keep your eye on the prize. We'll see you next week here. And this is Old Numbers Man from Cranston Analytics.